All eyes still on that Black Sea Ukraine deal there to see the grain deal to see if we get that extension we're all, waiting for at this time. But to our first conversation now, the failures of SVB and Signature Bank and tumbling banking stocks has raised fears of a broader economic collapse similar to the 2008 financial crisis. With the world being a global village, what is the risk of contagion to Nigeria's financial services industry? Joining me now is Professor Joseph Nnanna, Chief Economist, Development Bank of Nigeria. Join me from our Abuja studio. Great to have you. Good morning. Hello, Prof. Good morning. Okay, so, Prof, following the bank run on Silicon Valley Bank, marking the second largest bank failure in the United States history, this, obviously has sent shockwaves across the global financial landscape. What is the risk of contagion to the Nigerian banking industry? We've seen experts and stakeholders say, there's not there's no contagion risk, to our banking industry sector here. But I want to know your view on this.
Okay, thanks, Lady, for the question. So, in general, I think experts have already alluded to the point that there is no risk for contagion. That's simply because the central bank has already articulated with their macroprudential guidelines, which speaks to the financial soundness indicators. Essentially looking at the capital adequacy, liquidity ratio, the earnings, asset quality of the respective banks. Now, based on the numbers they're seeing, they're quite comfortable with the overall stability of the banking system. However, where I have I differ a bit is from the lens of, if you will, the moral hazard problem. So in the US, like in Nigeria, when banks fail, typically the FDIC, that's the insurance corporation, would typically step in and take charge and essentially pay depositors up to the limit they have put in, which in the US is around $250,000, and in Nigeria around, I think, 200,000 naira or so, thereabout. But I think what's important here is for the financial system to be stable and resilient, we have to see the mechanisms play out, meaning the NDIC will have to step in and take charge and help depositors out with their funds and so on. But for now, we'll say the financial system is sound and stable and resilient, simply because all the financial soundness indicators are in a comfortable parameter where the central bank likes to see them. That said, I don't see a risk for contagion at the moment.
All right, but looking at the whole, Naira redesign policy and the cash scarcity, right now in the country, and seeing how, banks are kind of overwhelmed, at this time, would you say it's similar to a bank run, what the banks are going through with, cash scarcity?
Well, I wouldn't call that a bank run, laddie, because the cashless policy was aimed at removing cash out of the economy, essentially trying to capture the banks outside of the formal sector. That said, for me, I look at it from the lens of the capacity of or the infrastructure capacity to support the payment systems. Now, we've had the central bank governor come on to tell us his sincere apologies for the way it played out, notwithstanding households, MSMEs broadly went through, and broader the economy at large went through significant struggles, trying to withdraw cash when cash was not available, trying to make payments in the platforms, and let's just say the deterioration of that caused essentially lowered activities in the banking system. So because of that, I'm comfortable saying that we can easily expect a lower GDP figure for this quarter. Having said that, I sincerely believe that there are being systems in place right now where they're propping up and supporting the infrastructure to support the respective payment platforms. Now, Nigerians broadly have been in pain and struggled. Businesses in a large part of the country has actually slowed or closed down because of this payment system mishap. Notwithstanding, I wouldn't argue that that's a bank run, but we do know a bank run essentially is not good for any banking system, and for me, I still go back to the moral hazard problem. If banks are challenged and they have to close down, then the deposit insurance company would step in and do their work. If they can't do their work, then we can't really say the banking system is resilient, because we have to test every mechanism within the system to demonstrate the resilience of the sector.
And definitely the banks have been, right here in Nigeria, have been tested, with the platforms, seeing how, the banking apps are struggling to, get transactions over. But, experts have blamed the Silicon Valley Bank collapse on interest rate hikes, by the U.S. Fed. And, we did see yesterday, they did about 25 basis points. I'm sure, everyone expected that because of what's happening, in the U.S. banking industry. And right here in Nigeria, also raising rates to, 18% now. So would the best play for banks would be to not, to focus on liquidity for now, maybe not give out all those loans? What do you think happens to credit going forward?
Well, the economic principle tells us that when the MPR, monetary policy rate, goes up, then the monetary authorities are signaling to the fiscal authorities that slow down on spending, because in the end, we're trying to say that we're taming inflation, and ultimately, to tame inflation, you sacrifice some level of economic growth. Now, what we need to see in Nigeria is a stronger coordination between the monetary and fiscal authorities. Back 10 years ago, well, maybe 12 years ago now, during the global financial crisis, the outcome or fallout of the global financial crisis told us two things. Easy money came to stay, and low inflation. Now, this crisis fueled pandemic, that's the COVID-19, and of course the Russia-Ukraine war, ultimately told us one thing. High inflation, which is totally different from what's occurring 2008, 2009. So if we know that is true, then the same prescriptions cannot apply in this context. That said, monetary authorities back 10 years ago or so could easily muscle their way through and save the economy and be very powerful, if you like. But the truth of the matter is this. Now the tables have changed, because we know that the fiscal authorities want to spend for growth, and the monetary authorities have to hike rates, which makes it harder for them to spend, because you have to service your debt obligations, which makes it more expensive for the fiscal authorities. To that end, a better coordination needs to occur, because in the end, if we're trying to achieve the IMF or the CBN projection of a 2.9 to 3.1 GDP growth, we have to basically speak to each other to demonstrate that we're sacrificing holistically to achieve inclusive growth for the economy. Right now, I don't see much coordination, but I suspect there will be more coordination occurring, because we know that times are tough. When the rates go up, people feel the pinch. Banks are less likely to loan money out. But guess what? There are these prudential guidelines which already, loan to deposit ratio already tells us that banks must lend money out. The question now is that going to cause higher NPLs? Right now, the NPL for the banking system is around 4.2 to 4.5%, which is right below the regulatory requirement of 5%. Notwithstanding, if banks are forced to lend money out, we can expect higher NPLs. But because we know that the system right now is a bit challenged because of higher rates on interest, I suspect banks will be less likely to lend money out, and my hope is there will be less money going out through intervention funds.
And
outcomes there.
in the U.S., we saw experts and economists talk about, the U.S. Fed, might end up breaking something, in the economy. And then we saw, what happened in the banking industry. So looking at it like here in Nigeria now, would you say the MPC have broken anything in the Nigerian economy with the rate hike so far? Or is there a risk of breaking something soon?
That's an interesting point. But let me say this. We have to know what the Monetary Authority's core mandate is: price stability and financial system stability broadly. So they have limitations in their toolkit, essentially saying controlling money supply and so on to fluctuate or moderate the interest rate. But the truth is, if they have gauged as money supply is up, they have to do what they can to reduce that, and which is to hike rates to reduce the lending. However, we know that it's not just the money supply that's the problem. There's this cost push inflation, which is more or less a fiscal policy side too. So the fiscal authorities will now have to look at their plans on how they need to recalibrate to ensure that they're not spending as much and they're taxing not necessarily at a higher rate, but they're broadening the tax base. That, to me, is ultimately what needs to occur. So the coordination needs to be deliberate, and it needs to be at least functional enough to demonstrate that both hands are working together to build an inclusive country.
And, with the whole cash crunch here, we did see the NLC give the central bank an ultimatum on, releasing cash. And now there are going to be protests soon. And they've instructed their members to, block most of the central bank offices in the country. What do you think, what impact do you think this is going to have, right here in Nigeria, blocking, all of those offices and the protests?
Well, the NLC can stir up protests to infiltrate as much as possible to influence the central bank. Notwithstanding, I would say the central bank should remember that public opinion matters a great deal. Their credibility matters a great deal. But I don't see the NLC strong-arming the central bank to doing anything they're not willing to do, especially if it's at the detriment of the greater economy. Like I said earlier, the mandate of the central bank is price stability. And if their job literally is to hike up rates when inflation is up, then it's no longer their responsibility at this juncture. It passes the buck back to the fiscal authorities to recalibrate. So the NLC might be, unfortunately, barking out the wrong tree. My suspicion, however, is that the challenge might be with the cash. And if that's the problem, then the central bank will have to release as much cash as possible to kind of quail the uproar of NLC members and what have you. But notwithstanding, the payment systems, however, has greatly improved. So I suspect the idea and the implementation, albeit muddled up, has actually bared some positive fruits, because ultimately we've seen more and more people accepting electronic payments. You go into a taxi, you can transfer to make payments. You go to a market teller, you can transfer to make payments now. But the challenge is not everybody has collectively accepted this as a means and mode of payment. Notwithstanding, we've seen progress, and the NLC should try as much as possible to be patient, because ultimately Rome wasn't built in a day.
And Prof, it's funny you say most of these sellers now accept, electronic payments, because I was able to, pay for my yam, recently, via transfer, and normally I couldn't do that before now. So I guess we could count that as one of the positives. But looking at all of this now, when the dust settles, how do you see bank customers interacting with cash, going forward after, let's take, for instance, the CBN releases enough cash, into the economy. Do you see them going on some kind of a deposit run, on the bank? Maybe they want to get out as much cash as possible, for fear of, another cash crunch.
Well, that's a fair assumption. And the truth is, human beings are sometimes irrational. And fear makes human beings irrational. And that's because of their past experiences. But notwithstanding, I think we've seen enough instances. You've mentioned using electronic transfer to make a payment for yam, for instance. So if that works and the person, the seller, accepted the payment and confirmed it, then I would imagine, on average, most folks can achieve that mode of transaction to achieve their goods they're trying to purchase or the services being rendered. Notwithstanding, that doesn't mean people won't still go to banks and withdraw their money. But in the end, the idea is not to withdraw money because there are limits that the central bank has already set of how much you can take over the counter and how much you can withdraw from the ATM. So if you want to draw large sums, it will take you many, many days or weeks to accumulate that amount of money. That said, you're only attracting criminals to your house.
Yeah, obviously, just leave most of it in the bank at this time. But, you know, we've been battling inflation since 2022, you know, global central bankers. You know, with what we're seeing, you know, here in Nigeria, we got that, you know, hot inflation data for February, about 21.9%. In the UK, it also unexpectedly rose. That's for inflation for February. Do you think we'll be able to solve this inflation problem in 2023?
Before I answer that question, Ladi, my issue with inflation in Nigeria is that we don't have a sense of which direction inflation is really going. For instance, last month, inflation went down. This month, it went up. And it was cost push that was the driving force. And the reality is we have to have a firm position, that's the MBS at least, has to be deliberate in recalibrating the weighting systems of the respective buckets, whether it's food, the percentage weight they put against food, core, and so on. That makes up the headline inflation. In my mind, we have to do surveys to go out to the respective jurisdictions, the markets, and so on. Get the data. Data is expensive. NBS needs to be financed and supported to go out there and get the concrete data to put into the models before pronouncing what the inflation figures will look like. Right now, NBS has said inflation is 21.9%. We all know that if you go out, cost of transportation is up. Gas is up, food is up, and it's not up by a small margin either. So inflation might actually be much higher than we're seeing. And ask the common man on the street, ask the households who spend money in the markets, how their purchasing power, has it improved, has it decreased? Then you really know where the rubber meets the road. But for me, I would be remiss if I don't say NBS needs to be supported in ensuring that they have the right financing to go out there and get the data in order to compute the inflation figures. Maybe we need to recalibrate the weighting system of what comprises of the weight for the basket of food, for instance. Is it core, energy cost, and so on? But by and large, I feel and I believe that in the end, once we see inflation and the reports coming in a timely manner, and it resonates with the people, because ultimately it is the people that will tell you if the inflation figure makes sense. Because I can tell you, the average person will tell you, inflation has gone much higher than the NBS is letting on. And if that is truly the case, then perhaps MPR must be much higher too. And the fiscal authorities may have to do much more work in essentially curbing the spend and taxing the base.
Right. Yeah. Well, when you go into the stores, yeah, it feels like the prices keep going up, you know, daily at this point, even when you're trying to buy eggs. All right. I guess we'll leave it there now.
Especially eggs.
Especially eggs. Thank you so much, Professor Joseph Nnanna, Chief Economist, Development Bank of Nigeria. It's great having you today.
Thank you, Ladi. Have a great day.
All right, so still ahead on Business Morning, we're looking at commodities market update. That's our next conversation. Do stay with us. This is Business Morning.